Hello all of you knowledge seekers and welcome back to Knowledge with Alar. In this video we will continue with modern value investing. We have reached book 2 of this series, all about the valuations of companies and the technical side. So stick with me, it's gonna get interesting. So the book 2 of modern value investing is all about the technical side, behind the scenes stuff about investing, doing fundamental analysis on companies, and in this part of the book there are 25 tools to use to evaluate companies. We will learn how to calculate intrinsic value, how to find margin of safety in your investments, how to find catalysts in the market so that you can take full benefit from having these catalysts involved, how to avoid value traps, and how buying at a discount will lead you to long-term higher returns. And guys, if you haven't seen the book 1 part about modern value investing yet, then please go check out my channel and you will find all the previous videos there. And if you like this video, please give me a thumbs up. The point behind the 25 tools is that no valuation can be precise. There are simply too many variables to be completely accurate. If valuating companies would be 100% accurate, then computers would be the best investors. Thankfully, that isn't the world we are living in. Gareth Reed has said, "It is better to be vaguely right than precisely wrong," and it is completely accurate about value investing. It is important to minimize the probability of being wrong. That way you will have margin of safety in your investments. Some of these tools may seem obsolete in a modern online business environment, but can still be used for comparative analysis. Chapter 5. The Art of Business Valuation. Quote, "Price is what you pay, value is what you get." Warren Buffett. Some think that the market will always tell the exact value of a business. However, history has shown that the market can be very irrational. Knowing how to properly evaluate the company will give you an edge on the market. And if you use that advantage, you can take advantage by exploiting the mispricing of the market. You have to keep in mind that this is never a precise science. You just have to compare the price to your range of values. If your criteria are not met, you simply move on and look further. And this is the main reason why many people aren't value investing. Value investing takes a lot of research, a lot of time, a lot of patience, and a lot of saying no. But putting your time and effort into looking for the right companies will lead you to higher returns with less risk. Successful investing is simple. There is no need for fancy formulas. All you need is common sense, willingness to do research, a computer, and access to the internet. Tool number 1. Using a range of values for investing decision making. When doing a business valuation, you have to keep in mind that it is never going to be 100% accurate. A back of a napkin valuation can be much more valuable than hundreds of Excel spreadsheets of data. Take a look at Wall Street and their valuations. They have a quite large range of valuations. The differences are quite staggering. And you will also get a range of valuations when you do your research. The key to value investing is to buy when your most pessimistic valuation is above the price the market is dealing at. Then you are buying at a bargain with margin of safety. And when you have a long-term perspective, that gives accuracy to your business valuations. Value should scream at you. Benjamin Graham. When you do your research and you find a company that is screaming value at you, you should buy big. 4 steps when determining value. To outperform the market, you have to buy when the seller is wrong. And the 4 most basic tools for evaluating companies are net present value analysis, liquidation value, stock market value, and value to a private owner. The 4, in addition to calculating intrinsic value, probably constitute the best way to value a company. And note that each tool has its strengths and its weaknesses. Tool number 2, net present value calculation. The net present value is the discounted value of all future cash flows a business is expected to generate. I will do a separate video where I will go more in depth about what net present value is. So in this video I will just give a quick summary of the topic. The difficult part about NPV comes when you're assessing the future cash flows and determining a discount rate. You can also use earnings, because in the long term the earnings are correlated to the actual value the company creates and its cash flows. But you can never know if the management will distribute the earnings to shareholders or reinvest it. Predicting the future is impossible. It goes down to accurate guessing. It is best to keep your estimation on future cash flows conservative while calculating net present value. And when choosing a discount rate, you have to keep the risks in mind. When you are analyzing a riskier sector, a higher discount rate should be used. For example, if you're evaluating miners, you have to take a larger discount. That sector is very cyclical and quite volatile at times. And if you evaluate a blue chip company, then you can use a lower discount rate because it's more stable. And in this case, many use the 10-year treasury yield. It has been between 1.2 to 6.4 historically. Tool number 3, liquidation value. Liquidation value is net values minus liabilities. So that includes long and short-term debt. When a company is priced near or lower its liquidation value, then it would seem that this is a bargain, but that is not always so. You have to be really careful about what the assets of a company are. When a company goes bankrupt, many of its assets are going to be sold for a lower price than they are on the book value. Or even worse, the assets are simply illiquid and you can never get rid of them, so they hold no value at all. For example, let's say a company has some old equipment they bought at 1 million. On books, it is written down as 1 million, but when the company goes bankrupt, they might have to sell that equipment for 500,000. Or even worse, maybe no one even wants to buy that at all, so you have to just scrape off the 1 million. And in today's market, it is really hard to find companies that are trading below that value. The S&P is way overpriced. The price to book ratio is around 3. And while you are evaluating companies' worth, you have to keep in mind that often the data that is shown there is really outdated. For example, if a company bought a factory in 1990, then on the books it is still written with the price that was used in 1990. But the land underneath the factory can be worth a lot more now than it was previously. So it might happen that the land is actually worth a lot more than the whole factory combined. And when you are calculating the company's assets, you have to be always conservative. The more you discount your valuation, the bigger margin of safety you will have. Tool number 4, stock market price. Stock market price is taken into account when you are comparing a sector. You compare intrinsic value to the stock market price of all the companies in the sector, and then you can see which of these companies are selling at a reasonable price or even a bargain. You should also look at the stock market price when valuing a holding company. A company that consists of many different companies, so you value all those companies separately, add them up, and then you can compare it to the holding company. There have been times when holding company is really trading at a bargain price, and if you know the real price of the companies combined, then you can see where the price can go when the market discovers the bargain price. Tool number 5. Look at what the value of a company can be to a private owner. There are many takeovers when the market is really in a favorable position. Private companies' value doesn't fluctuate as much as public companies do. And in private companies, liabilities affect the price a lot more. Two companies with equal earnings can have totally different valuations if one has larger liabilities. When comparing companies, you should take a possible takeover into account. it can add an extra layer of margin of safety. And different sectors are valued differently. Social media is valued by the user base, but a store is valued by its profits. You should find 5 different factors that affect the sector. Always be pessimistic when valuating. It gives you a bigger margin of safety. So these were the first 5 tools to use in evaluating companies. In every tool you have to keep in mind that be conservative, because in the end, if the company exceeds your expectations, then you will do extremely well. And if you find 8 of such companies in your lifetime and you invest in those only, then you will do extremely well. So thank you guys so much for watching. I really hope you liked this video. If you liked it, give me a thumbs up. Please subscribe to my channel, leave me a comment down below, and I will see you in the next one. Bye.